If you're thinking about buying a house as a first-time home buyer, you're probably wondering what mortgage option is best for me. Give me 10 minutes or less and I'm going to explain your mortgage options, and you'll go away knowing what mortgage is likely best for you. Because unless you're paying cash, you are very likely getting one of these 4 mortgage types. I'm going to tell you the down payment required, some of the other requirements, and the pros and cons for each. I'm Brianne Du Bois with Moving to Middle Georgia Realty Group, and I love helping people just like you. So if you're looking to move in 9 days or 9 months, I would love to chat. My contact information is in the description. Let's go. There are 4 primary mortgage types: VA, USDA, FHA, and conventional. The first 3 of these are government-backed mortgages and for owner occupants. So they're going to require you to live there for at least 1 year before you think about renting it out. Although there are some workarounds, the government is primarily just trying to help people buy their first house to live in, not for investors. So you have to live in a house for at least 1 year. So just be mindful of that for the first 3 loan types that we're going to discuss this morning. The first loan option is VA loan. It stands for Veterans Administration. VA loans are a type of mortgage loan offered to veterans, active duty service members, and even some military spouses. It's backed by the U.S. Department of Veterans Affairs. These loans offer significant benefits that make home ownership more accessible and affordable for those who have served in our military. Some of the benefits are no down payment. That's one of the biggest advantages of this VA loan. They don't require that down payment, which can be a huge benefit for buyers with limited savings. No PMI or private mortgage insurance. Unlike conventional loans where PMI is required if you put down less than 20%, VA loans don't require PMI even with no down payment, which can save you hundreds of dollars per month. Competitive interest rates. VA loans typically offer lower interest rates compared to your conventional loans as they're backed by the government. This can also result in significant long-term savings. Easier qualification. VA loans often have more flexible credit score and income requirements, making it easier for veterans and military personnel to qualify. And limited closing costs. It limits the types of closing costs veterans can be charged, reducing those upfront expenses. There's no prepayment penalties. You can pay off that VA loan early without worrying about prepayment penalties, allowing you to save on interest over time. And it can be assumable. The loans are assumable, meaning if you sell your home, the buyer can take over your loan if they meet the VA's eligibility requirements. This can make your home way more attractive to buyers, especially in rising interest rate environments. The VA loan limit for all counties in Georgia is $766,550 for a single family home. A con could be, while VA loans don't require down payment or PMI, they do come with a funding fee. This fee helps keep the VA loan program running and is typically a percentage of the loan amount. The funding fee can vary depending on factors like whether it's your first time doing a VA loan or a subsequent one, how much, if any, down payment is made. However, veterans with service-related disabilities may be exempt from the funding fee, which is amazing. Number 2 is USDA loans. It stands for United States Department of Agriculture, and these are for people moving to homes in rural areas. Approximately 97% of the land area in the United States is classified as rural. So however, while rural areas, say that like 10 times fast, rural areas cover the vast majority of the country's land, only about 19% of the US population lives in those regions. This vast amount of rural land is one of the reasons USDA loans are a valuable option for many home buyers, as they're designed to support home ownership in these widespread, less densely populated areas. Rural doesn't necessarily mean remote. Many suburbs and smaller communities surrounding major cities can qualify for USDA loans due to their lower population density. The disadvantage of getting a USDA loan is that you have to live in a USDA zoned area. I mean, it depends on who you talk to if that really is a disadvantage, but however, the major advantage of this loan is 100% financing. The US government wants to incentivize folks to settle in rural areas. So the pros? No down payment, 100% financing, and lower interest rates than your conventional loan types. But the cons? You have to move to USDA area. There are 2 types of USDA loans, USDA guaranteed and USDA direct. With the direct loan option, the US government will help you pay your mortgage in subsidies. This is primarily for lower income families. So one of the other cons or disadvantages, they do have maximum income requirements. So if you make over a certain amount, depending on your area, you may not qualify for USDA. FHA is our last government-backed loan type. It stands for Federal Housing Administration. FHA loans require a minimum down payment of 3.5% for borrowers with a credit score of 580 or higher. This loan type is a lot more forgiving of lower credit scores, and you usually have lower interest rates and closing costs. Some cons of this one is the mortgage insurance, and the FHA has strict property requirements. So homes that need significant repairs or updates may not qualify for FHA financing unless you use a 203K loan. And last, but certainly not least, conventional. Conventional loans are mortgage loans that are not insured or guaranteed by the federal government, unlike FHA, VA, or USDA loans. Instead, they are typically offered by private lenders such as banks and credit unions. Conventional loans typically require a down payment ranging from 3 to 20% of the home's purchase price. If the down payment is less than that 20%, borrowers are usually required to pay PMI, which protects the lender in case of default. PMI can be removed once the borrower achieves 20% equity in that home though. This type of loan typically requires higher credit scores than government-backed loans. Most lenders prefer a minimum credit score of around 620, though some may require higher scores for more favorable terms. Lenders generally look for DTI ratio of 36 to 43%, meaning your total monthly debts, including the mortgage payment, should not exceed this percentage of your gross monthly income. Some lenders may allow higher DTI ratios based on compensating factors. Disadvantages of conventional loans: you have a higher down payment. They may require a larger down payment than the FHA or VA loans, which can be a barrier for some buyers. Strict qualification standards: borrowers typically need higher credit scores and lower DTI ratios compared to government-backed loans. And PMI costs: if you cannot make a 20% down payment, the additional cost of PMI can increase your monthly payment. With this loan type, you can use it as an investment or rental property since it's not government-backed and you don't have as many regulations. So that's a great thing. If you are a first-time home buyer and you're trying to decide which loan type to go with, I would personally suggest you talk to your lender about creating a fee sheet for you so that you could see how your mortgage will play out with all factors in play. PMI, no down payment, etc. Like, there are so many moving pieces to the different loan types. So get a fee sheet and see which option would make the most sense to you. I have a couple of great lenders that I could recommend if you're moving into this middle Georgia area. I don't get paid by them. I don't even get a referral fee. I just really, really value working with lenders that have great communication with both me and my client. This is the largest purchase by far you will ever make, and finding a good lender is so important. I can't stress that enough. Holler if you need recommendations. Thanks so much for watching. I hope you learned something new, and I'll see you next time.